Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Alex Duys, Umthombo Wealth, and Ricus Reeders, PSG, hole-in-one, Ruimsig. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gentlemen, appreciate the time. Let's kick off with Naspers, some also perhaps process results. Alex, I mean, still 10 cent, but we're getting some traction there with their iFood business, with their OLX. As I say, still dominated by 10 cent, but thoughts on the sort of attempt to shift away?
Yes, agreed, Simon. So they've certainly made a lot of progress there. I mean, for me, the big one, of course, is the fact that they're generating free cash flow.
Yeah.
So that part of the portfolio has been bleeding cash for pretty much since inception. And that has led to the big discount of the sum of the parts. So the more that free cash flow number increases, at some stage people will start looking at Naspers Prosus perhaps as a 10 cent plus other assets as to a 10 cent minus. I think key to note is they are doing also quite a lot of acquisitions. So we saw the Just Eats and a couple other deals they've done, but also cleaning out the portfolio. And I think they're running the balance sheet a lot better now, and hopefully as they produce more cash from there, and they have the ability to perhaps in future unbundle some of these assets at peak valuations, which will give investors a better understanding of what a true valuation is. But the new management is certainly done the good things there, and we think Naspers Prosus are well positioned if you take a medium-term view.
Ricus, I mean, it was almost, I mean, the attempt to sort of, and I like the phrase, become a 10 cent plus rather than a 10 cent minus. I mean, it kind of felt that it was never going to happen. And then suddenly, kind of, here we are. Early days, but we're in the right direction, perhaps, for the first time, I don't know, ever.
Yes, I mean, if you just take a look at Prosus, it was growth across all sectors. Latin America by 32%, so they classify as doing very well. Revenue growth of 22%, and even in India, a return to growth on the PayU platform. So it really looks like a very good set of results. Unfortunately, I think somewhat in the share price as well. If we take a look at what's happening on the markets today. And it's not because of 10 cents, which is low, because that was up in Hong Kong this morning. So maybe just a bit of a pullback, and with the provision that China can do strange things, as I always say. Possibly 10% downside in the share price, but back to buyable levels if you're that way inclined.
Yeah, it has been a pullback, but I take your point. I mean, and today in the price, because I think at one point this morning, 10 cent was up almost 2% in Hong Kong.
Yeah.
Let's stay with some results coming through, a lot of them today. Ricus, Invicta results, not bad, lots of cash. And I remember Stephen Joffe saying the last set of numbers, the preference share is gone, they're doing share buybacks, so that obviously helps with cash generation. And also doing a lot of sort of little acquisitions, a stock that always looks good, but the market never seems to have fallen in love with it. Thoughts on Invicta?
Yeah, it's the share price is ticking high, and I've got a sort of a short-term target of about 42 Rand on that. As far as results were concerned, their earnings up 20%, but that's really because of share buybacks. Because if you take a look at operational earnings, they got squeezed by cost because that was down about 6%. But cash generation is there. Their debt is looking very, very well. So hopefully, if they can get those costs under control, it will start coming through in the operations as well.
Yeah. Okay. And I have to say, I hadn't actually looked at an Invicta chart in a month or two, and it's not going nowhere. It's going the right direction to a degree. Alex, thoughts on the Invicta numbers for you?
Yeah, I think it's a decent set of results considering how tough the situation is. I think the key for Invicta is to try to narrow that discount from a share price to book value.
Yeah.
Another way you can do that is to continue to enhance the ROEs and returns of the business. The share preference shares that you referred to as part of that, and also continue share buybacks. And they're looking to do deals that are perhaps better than the core business. So they did also last year a deal in the UK of a company that they think was exceptional payback period. They just did another deal now with Spalding. So we'll have to wait and see how that pans out over time. I think Kian and the associates taken are struggling a little bit because of the tariffs. And obviously in SA, the economy has not picked up yet. If you look at the parts business, they need to see improvement there, but they have done quite well in the capital equipment side because of better mining conditions. So it is a business that is geared to economic growth, not only locally, but globally. Unfortunately, with the tariff issues and supply chain problems we've had, and perhaps lower than usual growth, that's not tech-related. The company has not been able to fire on full cylinders, but we've got confidence in Stephen Joffe. I think he's doing the right things. Just needs a little bit more tailwind from the economy, and I think the share price will follow.
Yeah, another company that just some good old-fashioned GDP. Suddenly things start to look a whole lot better. Alex, Oceana results, solid, lucky start. Their words, not mine. Fish oil weaker. We knew that happened. The Peru story, which was out of market for a while, is back into the market. I say this every time. I'm always intrigued by fishing stocks, but I never end up buying them, and it's usually a good thought. Your thought on the results and the investability of Oceana? The value proposition.
Yeah, look, I mean, when you invest in a food producer, you would prefer to have more stable type margins. And that is not possible with Oceana since they are tied to cyclical factors like fish oil and fish meal prices. Obviously, catch rates as well plays a big role. So I think it deserves a discount relative to other food producers. But saying that, this business can, when the stars align, can make very good money. And the margins in that specifically US business is much higher than the core business. So you want to buy this business when they're back against its cyclical lows, similar to like Astral perhaps, and then for the turnaround to happen, and you can make good money. But I don't see this necessarily as a buy and hold type of business. And I think they obviously did generate super profits, which wasn't sustainable. I think this is now back to more normalized levels. And I think if you look at it from that perspective, I think the operational results were quite decent, and I think from this base, it's probably looking a bit more interesting than it was perhaps in prior years' base.
Yeah, and to your point, the fish oil story was they benefited from it, but it was very much one-off. Ricus, some lucky star for you?
I think Alex has given my view, basically. You know, it's as you said, it's a bit like Astral. You know, when the going gets good, you can make a lot of money in the short term, and then things turn against you, as either, in Astral's case, a disease strikes, or when Oceana's case, the catch isn't where the ships are. So it's a very difficult thing to buy and hold, or I wouldn't suggest it at all, but imminently tradable.
Yeah. Yeah, I take your point on that. Absolutely tradable. And if I zoom that chart out over a decade, there's been some nice moves in it, although it's also been a bit of a trend heading down. PPC numbers out. Ricus, this is another one. I mean, there's stuff going well for them. The bigger story is they need some GDP growth, perhaps more than anything. And perhaps a working Lafarge South Africa also perhaps is going to take some shine. Thoughts from Ricus, PPC?
Yeah, I mean, that turnaround situation is continuing very well if you take a look at the latest set of results. But to really boost prospects, you can't rely on that turnaround. You really need growth in the real economy, which is where they sell their product. So I think the market was expecting these results to a certain extent, but it's a cyclical business, and at the moment, that cycle I don't think is yet in their favour.
Yeah, Alex, and for you, I mean, it is, again, you know, if we had a 3% GDP or even a 2%, it would be a fundamentally different story.
I think also need to give credit to the management. They've been in there for a while now. When they came in and made, you know, big claims that they're going to increase efficiencies, and the previous management didn't run the business well. And I think this set of results proves that they have done well. I mean, the margins has improved substantially. I think it's South Africa and Botswana. I think earnings went up 30% on very low volumes. So that's impressive. So it shows you the business probably will be well geared for any uptick in economic activity. And if you listen to what the likes of Raubex and Wilson Bailey is saying, it seems like projects are coming through the door at some stage. We just need this big transmission lines and renewable projects and so forth start coming through, and specifically in private sector business confidence. And I think PPC will be well positioned for that. Obviously, they're also investing in that plant in Western Cape, which will have much lower costs, so it means margins will be higher. So I think they're doing the right things, but they do need that GDP growth for tailwind.
Yeah, I take it away. Management, the new management team are certainly doing well. I suppose they're managing what they can manage, which is what we can expect from them. Alex, Netcare results out. We've had some insight into life as well recently. It's a small sector on our market these days. Not many stocks left. We used to have a bunch of them. It's kind of flat for 3 years. Your thoughts on the numbers and the investability into Netcare?
Yeah, I think relative to life healthcare, they obviously revenue is under pressure, but Netcare is controlling their costs a lot better. And you see that with the margin expansion here. So there's all growing earnings, which I think is a very commendable set of results. They also generate very good cash flows. And with that cash flows, they've been buying back shares and paying good dividends. And I think that shows us that's a good capital allocation decision. They've learned the lessons from going overseas. It didn't work. But I think, yeah, the top line is still the issue. They need that paid patient days to start picking up. Occupancies to go even higher, specifically when it comes to surgeries where there's higher margins and so forth. So, I mean, now, of course, private medical aid in South Africa hasn't really grown because of the lack of GDP or GDP per capita coming down. So those are a bit of a headwinds, but I think they are starting to do a bit better. I mean, they've really struggled since COVID, starting to see some green shoots for the first time since then. So if they can continue this trend, perhaps grow double digits from this base, then Netcare does look interesting.
Yeah, because I always thought the idea of hospital groups were great, because if I'm sick, I have to go and hopefully my medical aid pays, and they're kind of like a hotel, and that paid bed days is what matters. But that's never quite panned out. Your take on the Netcare?
Well, if I compare it to life healthcare, I thought that it did pretty well. I like the graph, by the way. It's as you said, they've struggled since COVID, but the share price has been picking up. So I thought quite a good set of results, and if they can maintain their revenue at about 4 or 5%, which is what they say they want to do, if they can maintain their operating margin at around about 13-14% at the moment, just on a discounted cash flow, we're looking at 15-20% higher from here as far as the share price is concerned, and it sort of ties in with what the graph is telling me.
Yeah.
Not a sector I like because of government interference every 5 seconds, but just on the face of it, I thought pretty decent, and I think an attractive looking graph.
Yeah, no, I take your point, and it's regulatory, and perhaps more so here than in other economies, but always that regulatory risk. Let's get to news that kind of broke and then unbroke. I mean, I didn't even see it break. I just saw the unbreaking of it. BHP again walking away from Anglo American. Alex, I'd like them having more separate companies better, and of course Anglo looking to do that Canadian deal, which will make them a significant copper player. Anglo American, let's touch on that one. I mean, it is very much going to be focusing on copper once it's done the Trek deal.
Yeah, they're going to have, world-class copper assets with good growth prospects as well. So, they're trying to position for that, and if they are correct, and copper is in high demand as they believe, then those assets should attract a premium rating relative to other commodities, right? So that is the idea there. They're still busy, of course, cleaning up the portfolio. They've really got a lot of Volterra, a couple of other smaller ones, and now looking at the beers. So it's pretty much going to be a play on copper, a little bit of iron ore, and so forth. So I think that they're well positioned, but it's, in our view, quite reflected in the share price to some extent, unless you're much more bullish on copper. But you can also play Glencore, buy copper, which we think is perhaps a better opportunity, specifically also if you're a bit more bullish on coal, which we are. So we think steel making coal and both metallurgical and thermal coal looks quite interesting to us at the moment. So our preference is for Glencore, but buy and hold on Anglo doesn't seem like a bad trade.
Ricus, Anglo, for you, I mean, it's actually quite weird, of course, because when that BHP deal arrived, and it kind of, I don't know, shook up management, and here we are, a fundamentally different business. Your thoughts on Anglo, which is going to become mostly a copper play?
Yeah, which is great. So in the short to medium term, that the broadening of their reserves, that's what you want in a company of Anglo's size, because that's the way you make money, by increasing your reserves. I'm a little bit worried on the copper outlook going forward because of the new Samanda mine in Guinea that started production in November, which basically, when that mine goes into full production, it will push Guinea from no copper, as far as the world market is concerned, to about the fourth biggest producer. So that's a huge reserve coming online. So although the outlook for copper, I think, is still pretty good, considering the spend we've got with AI and the infrastructure associated with that, one should take into account that there is the possibility, as I said, of a large resource coming online.
So you mentioned that, and there was a sense earlier today around Harmony. Now, of course, they've bought the Mac business, which is copper in Australia. They've now got the EVA copper project, which they say they can produce at, $2.50 per pound. Harmony going to become a non-pure gold play with copper there as well. Does that detract particularly? I mean, there's always a debate around single commodity miners, but when you've got two, it perhaps makes it a little more tricky.
Yeah, well, it's possibly better to have more eggs in your basket than only one. And let's face it, it's the Australian resource is not a difficult resource, so it makes sense rather than just going for gold. But I think, as I've said, one should view it on a sort of 4 or 5 year outlook and say, is it going to be as profitable as your current estimates is for or are forecasting.
Yeah, absolutely. And of course, I mean, lead times are massive in the mining industry. Alex, I mean, Harmony now being a gold and a copper play, and you've already said, I mean, Glencore would be your preferred in the space anyway.
Yes, so I understand from a management perspective looking to do that, to diversify the business. Also, if you look at the copper gold ratio, it's heavily in favor of that, of doing such a deal, using expensive gold assets to buy cheaper copper. However, from an investment perspective, you're looking for that single commodity because you know exactly what you want to buy. And if you're right on that commodity, you want to receive it back in dividends. Unfortunately, we're not getting a dividends Harmony because they're spending a huge amount of money on these projects. So I think that's frustrating from a shareholder perspective. These of the PGMs, we know if you get PGMs right, you tend to get the dividends back. But if the gold miners, you never get the money back. They're always investing. So that's a big frustration for me, and I think for a lot of other investors as well.
Yeah, that's actually a great point. I mean, we want the dividends. And I mean, Goldfields got sold off the other day because they're only giving back 33% of free cash flow. Question coming through around Spar. I hold Spar, maybe I've been far too in love with the stock. It's been a disappointment. The update wasn't great. Alex, would you look at one of the other food retailers in South Africa instead of Spar, or is there turnaround potential here? They are cleaning up the portfolio. The SAP problem is behind them. You think there's potential here?
Yeah, it's difficult to really clean up all the issues they've got. I mean, so they've also got some legal issues which are still not sorted. The SAP issue also not sorted yet. That still need to implement that group wide at some stage in the future. They're trying to get to South African operating margins of close to 3%, which are well off at the moment. And he's still got exposure to Ireland, which and they still need to sell the UK business. So a lot of these things are going to have, I think more payments are going to come. The balance sheet is going to take a big knock. So you're going to have to look at the business pro formally after all of these acquisitions. Ask yourself, where are they? What's new cash conversion? So there's a lot of complexity. I think to answer your question in short, a lot of complexity there. If they could turn it around and there's more normalized numbers, then you can see a lot of upside. But I would say with high execution. So depends on your risk appetite. Obviously, something like a Boxer, a Shoprite, much less risk, less risk there in the forecast. Pick n Pay, I guess, is in similar boats to Spar. High execution risk, but potentially a big payoff if you're right.
Ricus, they've also taken on debt from some of the acquisitions they've unacquired themselves from. Your thoughts on Spar?
I think their current business model doesn't put them in a favorable position. So they might be cheap at current prices, and let's say they get rid of all their problem children and they reduce debt even further. They are still sitting, I think, with the least attractive business model as far as their local operations are concerned, which is effectively what they'll be sitting with, plus obviously Ireland. And hopefully Ireland keeps on doing okay. So it's my thesis that even if there is value in the share, let's say they do get a turnaround and it is cheap at these prices, I don't in the end want to sit with a business whose model doesn't satisfy my outlook for future growth. So I would probably play a little bit safer and go for one of the other retailers.
Yeah. It is a fundamentally different model. That is a good point. Question came through. How do I get silver exposure locally? I hold the ETF. Are there any miners? Ricus, we only really have, it's either the ETF or the cutlery in your jaw. We don't have silver miners on our JSE.
No, only as a byproduct for things like the platinum miners, etc. But we don't have pure silver mining players in South Africa, as far as I know.
Yeah, and if there are, they're certainly not listed. Someone out there is like, no, we're mining silver, but not in the listed space. Alex, a question around Old Mutual. Going nowhere slowly, is this a stock that is worth continuing to hold?
Yeah, so we've had a close look at the capital markets day they've recently hosted. Some of the measures they highlight there seems to us quite interesting. And there's no doubt that this valuation underpin is there. But the ability to execute, I guess, is where the big question marks are. If they are going to focus more on the quality of earnings as well as cash returns and getting returns back to shareholders, I think there could be some value unlock. But they're operationally quite far behind something like a Sanlam and so forth, which is doing much better. So I guess there's question marks. You imagine, of course. So I think it's fair to give them some time. So I would say, from our perspective, we're probably at a cautiously optimistic at the moment on Old Mutual. But we're coming from a very low point where we were pretty much haven't invested in the share for many years. So, but I start getting back on our radar now, and I can see why certain investors like it, specifically if there's more shareholder activism and so implemented there. So, yeah, I would say lukewarm at best for us.
We're going to go for stock picks. Ricus, we'll get your Old Mutual take next time. Ricus, you're going with LVMH.
Yes, my stock pick before that was on their results. They reacted very positively. The share price in that sector has pulled back a little bit over the past 2 weeks. I think they are back to a viable level. And the main idea is that I think there's a lot of pent-up in demand in China, despite the pressure the average consumer is in China. I still think there's a market for LVMH in China. That's why they're opening stores there. And in general, as a market leader, and because of the diversity of their products, from jewelry right down to premier liquor, I think they're more diversified and not expensive at current prices.
Yeah, it is that diversification in the luxury space. Alex, you're going with Roynert, results out, and nice set of numbers, some good businesses in there, and your pick for today.
Yeah, so I think if you're looking for South African Inc. recovery play, I think Roynert is very well positioned for that. So to give you an example, so in the cables business, the highlight current volumes is about 10% of what it would be if Eskom starts rolling out the transmission lines, which they are going to do. And then currently they get zero from the private sector. The moment the private sector are also going to get involved in building those transmission lines. So there could be potentially enormous demand for their cables. Also in Zambia, we also got a manufacturing plant. Zambia economy is starting to pick up. So we think that part of the business is going to do well. The ICT side is currently at a very low point in the cycle. We see that in Altron results, capital appreciations, etc. So we think there could be a bit of a recovery if economic activity picks up, specifically business confidence. And then lastly, in the defense business, they talk about double-digit returns or growth going forward, and that's radios, radars, fuses, and so forth. We know the military spending theme is quite a quite a popular one at the moment. If you look at companies like Rheinmetall in Germany and so forth. So we think the business is very well positioned from a local and as well perhaps as a global theme on ARM spending. And we're buying it at a PE of less than 10, dividend yield close to 6. I would say it also at earnings well below normalized levels. So we like it at the moment.
Yeah, it's certainly cheap metrics on it, most absolutely. But that's all for our Stock Watch today. Thanks to our guests, Alex Duys, Umthombo Wealth, Ricus Reeders, PSG Hole in One, Ruimsig. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.